Alright, so the next is 6 is section 6. I used the black before, which is mutual fund growth. So, growth of mutual funds. The textbook completely misrepresents the idea that mutual funds have had a phenomenal growth, and this is like the first phenomenal growth in the history. Mutual funds started back in the 20s during the great bull market of the 20s, so-called roaring 20s, and back then mutual funds had a phenomenal growth. Usually during secular bull markets, the mutual fund industry grows like crazy, and in a secular bear market, when the market underperforms for 10, 15, 18 or 20 years, usually the mutual fund industry gets decimated. Maybe it will lose 3/4 or 90% of its investments. So since 1980, there has been or 1982, a beginning of a secular new bull market in equities and also in bonds. And from 1982 to 2000, stock market's been going up and up and up and up and up, and so has the mutual fund industry. Now, it is very tricky to attribute causality. Is the mutual fund industry growing because the stock market is moving up? Or is the stock market moving up because mutual funds are growing and pumping money into the stock market? And I don't want to get into this particular detail, but usually it is a self-feeding. Rising stock market results in rising mutual funds, and rising mutual funds result in rising stock market. So you get what is known in finance as positive feedback. One feeds on another, and it becomes a virtuous cycle until it stops, and then it becomes a vicious cycle. People sell, market goes down, then market goes down, people want to sell more, the selling drives the market down, and this is how the market cleanses itself out of the weak players. Alright, so what is the mutual fund? Let's see now the camera lady. If you would zoom in big time over here, you see number of funds from barely over here, from barely 500, this is 1,000. Are you zooming a lot?
Yep.
Alright. You see in 1978, very few funds. The dark one says stock funds, the light one says bond funds. And you see how in 1985 it's grown, almost double. In 1990, quantity-wise it has doubled again. In 1995, doubled again. And in 1995, increasing significantly, but not double. So what you see here is a total of almost 6,000 funds at the end of 1995, and these are the number of mutual funds. In terms of assets, the assets that are under management closely track the stock bull market. So as the market, goes higher, it attracts more investment funds, and advertising gets better and better, and it attracts more and more. So there's been an explosive growth, let's call it roughly 10 times. Over here from roughly 500 to roughly 5,000 in terms of number of funds. In terms of funds under management, from about 300, it will be billion, to about 4 trillion. So a 10-fold increase in the size of the So now, what is the distribution of mutual fund assets? Now, zoom in on this one. You see, the biggest one has been common stock, and common stock has been driving the industry. Then another big one will be municipal bonds. A little bigger one of 7% municipal and 7% government is government bonds. You see that cash, they maintain barely 5 billion, and for corporate, they maintain 9, almost 10. Preferred is a tiny, tiny little, and other is a tiny, tiny little. So the big chunks are coming from common stocks, corporate bonds, US government treasuries, and municipals. All right? This is what the mutual fund industry looks like at the end of the greatest bull market in US history, 1999. All right? So let's see what's next. The next section is 7, performance. And I would prefer to skip this section entirely because it's unnecessarily technical, doesn't bring you a lot of learning, and it changes a lot. I don't want to get into that, so this one is skipped. We move to 8, which is money market mutual funds. All right, this is 8. All right, so money market mutual funds, sometimes they're just called MMF, sometimes they're shortened MMMF, money market funds or money market mutual funds. So double MF or triple MF. All right, what do we have about them? Well, the growth of these funds came with one big feature, which is called check writing. So, money market mutual fund is supposed to give you a better return on a checking account, on a deposit. So, it is as equally safe. It was advertised even to be safer. All right? So, it was supposed to be a lower risk, higher return alternative. It was inconvenient because you didn't have a convenient, easy access to the money. Once you can write checks, suddenly it becomes a perfect, if not a better, substitute for mutual funds. All right? So, as soon as you allow to write checks, suddenly you allow for the explosion of the industry. Suddenly, commercial banks begin to bleed big-time deposits to money market mutual funds. Moreover, the real growth of money market mutual funds was predicated on a fairly incompetent rule by the central bank, which in times of rising interest rates and shortage of savings or shortage of deposits, let's just call them shortage of funds, because funds in the banking system consist of 2 things. One is savings from the economy, and the other one is freshly injected funds from the central bank, and possibly expansion of the money multiplier. So, in times when money multiplier isn't expanding, and the economy is in hard times during the 70s, and there's shortage or relative, scarcity of saving, the fundamentals are for interest rates to go up. And banks viciously compete against each other for those funds. And Fed says, oh, everyone's offering 5, 5.5, 6, 6.5, 7%, 8%, 9%, and this becomes a destructive competition where the next bank offers a higher interest rate, grabs out of its competitors, but if the pool of funds is the same, banks are better off paying all 5% instead of all paying 10%. In other words, competition for funds, market pricing would want them to be at 10%, but Fed says no, we're going to put the limit at 5. Well, if you put the limit at 5, and all bank provide, we'll call these interest rate ceilings. Let's write out the concept. Interest rate ceiling. This is the maximum amount of interest rate that a commercial bank may pay to its depositor on its deposit. So if the Fed says 5, the real number is not 5, and the money market fund and all commercial banks offer a 5 and the money market offers 10, suddenly it becomes a no-brainer. We call this in economics, I think I covered it a while ago, in one of our lectures, the law of unintended consequences.
Usually the ceiling creates a shortage, right?
Yeah, usually ceiling creates a shortage, but that's a different problem. Here, the law of unintended consequences work as follows. All banks offer 5, money market mutual fund offers 10. People can't get 6, can't get 7, banks can't compete. So, the idea was to eliminate competition between commercial banks by, prohibiting them to offer 6, 7, or 8, so they all offer 5. But the unintended consequence was that there was a non-bank financial institution, money market mutual fund, that could offer 10. So it rendered them uncompetitive. And when it rendered them uncompetitive, the interest rate ceiling, which was meant to help commercial banks and alleviate their problem of very high cost of funds, like 8 or 10%, because they weren't willing to pay the high market price. The unintended consequence was that they had cheap funds, but they were losing them because people were simply shifting them to money market mutual funds. So instead of helping commercial banks, it made their fate a lot worse. It exacerbated an already really bad situation. So, government trying to fix one problem, it actually made it much worse, And I discussed previous examples where government will put in a, high minimum wage, trying to help low wage earners, but the result is it renders them unemployed. It hurts exactly those parties which usually it intends to protect. Alright, so let's see what else we have. Another key characteristics is that they actually provide periodic statements. In other words, as soon as they begin to offer the same services as current accounts and bank deposits, suddenly they begin to be perceived, rightly or wrongly, as deposit substitutes, commercial bank deposit substitutes. So, periodic statement is another feature which makes it, to the customer, look much closer to a regular deposit account. Alright. It allows for redemptions. This is fairly straightforward. Alright, so what are the key characteristics? Well, mutual funds could vary across a number of things. Number one is, I will probably, let's see if they have it, composition. So that's number one. Number two is, let's try to make sure that I get it right, maturity. And number three is risk. All right. So these are the three primary characteristics that distinguish. So you can provide a matrix or a cube with different composition, different maturities, and different risks. All right. So by composition, you have first, you have mostly commercial paper. Alright, you all know what it is. These are securities issued by corporation, usually high grade, to finance short-term needs. If they have a long-term need, they'll issue a bond. Alright, the next one is treasuries, or treasury securities. Treasuries. And usually we like to say treasury bills, because a bill, T-bill, is an instrument with a maturity of less than 1 year. So this is the short-term instrument. And the third one is a repo, which we discussed last time, which is also relatively low risk. Now what we can do is try the same exercise over here. Take a look at the book. This is growth in money market funds. You see that in 1983 they were barely 160 billion. They're going to 1.5 trillion. You also see mostly taxable money market funds versus total funds versus tax-exempt funds. This is the growth of the whole industry. The next chart, it shows you the composition by instrument. The biggest instrument, commercial paper, 36%. The next one is US Treasury, 9%. The next one is repos, 12%. You have some CDs at 10%. You have some other at 17%. And other US securities at 15%. But the three primary ones, commercial paper, T-bills, and repos, are respectively 36, 9, and 12. In other words, half. These represent half the assets. Now, while we're zooming in, let's zoom on the bottom one over here, which is the maturity. And the maturity you see from the 70s has been steadily falling from 100 days to literally 30 days. In other words, from a little over 3 months to a little under 1 month. The reason is that from 1975 till 1980, interest rates were skyrocketing on the way up. And as interest rates move up, 3-month interest securities, 3-month securities will usually be running you losses. So, the faster interest rates rise, the shorter you need the securities to be to protect you from a loss of interest rate losses. In other words, you're protected from interest rates. You are protected from interest rates. As they rise, the principal falls. And for longer term bonds, the principal falls a lot. For short term bonds, it falls a little. And finally, if it's 30 days, it will fall next to nothing. So it was discovered back then that 100 days is too long maturity and too interest rate sensitive. So the higher the maturity, the higher the interest rate sensitivity. And again, the more volatile the interest rates, the lower must be the maturity to protect you from interest rate risk. Well, as during the 70s interest rate volatility increased and it was rising, it forced money market mutual funds to shorten the maturity to barely 1 month or less than a month. Alright? And then you have risk. They are sold as perfectly risk-free. And the lesson learned in history, they are risk-free until they're not. In other words, they have been for a long time, and during the 2007 credit crunch, and especially 2008, suddenly most money market funds froze. To freeze means that when you try to redeem your money, the money market mutual funds tries to sell the repos or the T-bills or the commercial paper. The commercial paper market froze. They couldn't sell them. They can't give you your money back. So, at that point, the world learned that money market mutual funds are far from safe. They are sold as perfectly safe. They are sold as risk-free. They're sold as perfectly liquid. But the world realized that they're not. What the world realized is that these were paying a premium over T-bills. If they were paying premium, the market perceived the premium as free. No, it's free. Oh, you're getting perfectly liquid, perfectly risk-free, but higher interest. How could that be? So, people were collecting this premium, for free, but they learned that it wasn't for free. They learned that there was genuine risk that the market would freeze. Now, money market funds are the key to operation of the US financial system today. Stock market is not as vital. And the bond market is not as vital. But the money market is vital for the operation of the financial system. So, when the money market froze completely, the government had to backstop it. To backstop it means that the government provides the guarantee or the government, the Fed, becomes the ultimate buyer, providing liquidity for those funds. Of course, the Fed was not meant to do that. It was illegal for the Fed to buy all of those assets. I mean, there were some laws and whatnot. The Fed is supposed to provide only stability of the banking system. But money market mutual funds have grown to the point where they have, or they threaten, systemic stability of the US banking system. Allowing money market funds for more than a couple of days to be frozen will result in systemic collapse or disaster for the financial system. So the Fed and the US Treasury stepped in to, we call it, backstopping. In other words, you need? No problem. We provide liquidity. We'll buy out temporarily. All right? You know? Well, that's how it works. That's how it works. In other words, the idea for any type of institution is always the same. You must become too big to fail, and you must become a systemic risk in order to profiteer from the government subsidy of providing you a backstop or a guarantee when times go bad. Alright, so when times go bad, you're posing a systemic risk, great. You're sure going to get a government bailout.
And if you have very small capital.
Very small what? Capital. Well, these are money market mutual funds. They're 100% capital. But the point is, people get scared. So what you had was a classic run on money market mutual funds. You have a run on the funds. Well, what does it mean, the run? It means whoever hold the liabilities or the equity, you know, the right-hand side, they go and they claim their claim. And when they claim, you have no choice. You got to sell assets. You got to maintain reserves. You use up your reserves and you're going to liquidate. Well, you liquidate if the asset is liquid. If you can sell, you liquidate and you redeem.
Yes.
But what if you can't? Well, if you can't, you're busted.
You're frozen.
You're frozen, right? So that's the idea to understand, which the textbook grossly misrepresents, because the textbook was written before the credit crisis and before this. So again, it was sold for what it was not. But because it worked for 20 years, it is assumed that it will work like this forever. And the answer is, it works until you get yourself a credit crunch, and then it stops working. All right? What's next? Management, money market, mutual funds.
And then does it work again?
Yes, the government was able to unfreeze those. The commercial paper market is called comatose. You know what's comatose? It's in coma. It's kind of like drugged up and, you know, kind of like drugged up and not really vital, you know. But it's kind of like recovering now, and it will take a couple of years to recover until the next credit crunch. You're having fun? You ready to go home? Or we got more sections. I got section 9. You want to know about hedge funds?
Yeah.
Yeah? All right.
Yes, hedge funds, big time.
Big time.
Yeah.
Hedge funds were over 3,000 just until last year, just until the credit crunch.
Is it the same as hedging?
No, nothing to do with hedging.
I know it's more risky than the mutual
It is,
fund.
okay, let's say, first of all, it is riskier. That's the first key characteristic, is riskier. The second key characteristic, which is intimately related to riskier, it is that most of these are typically leveraged. Of course, we immediately know from portfolio theory that higher leverage
Higher return.
makes the investment riskier. So high leverage results in higher risk. So riskier and more leverage are here. Second one is they use exotic investments. They may use, let's say, buy uranium, you know, they may buy commodities, they may buy a whole bunch of other things. Some of them use highly refined arbitrage strategies where they search for mispricing between, let's say, Thai government bonds and Russian government bonds and US government bonds or whatever that might be. So they are looking for arbitrage opportunities. Some of them are highly leveraged, 10 to 1, 20 to 1, 50 to 1, all right? They involve huge risk and huge leverage. Well, hedge funds were all the rage, especially after the 2000 and 2001 stock market crash and the internet.com crash. Suddenly people learned that the stock market doesn't always give you free profits. Profits are never free. They're actually highly risky. When people got already burned, they started switching to hedge funds. Hedge funds were also meant to be mostly restricted to sophisticated investors. These are called by the law accredited. The law says if you have more than 1 million in investable funds, if you have more than a certain amount, let's say $500,000 in income, I'm just picking the numbers because they change all the time, and if you have blah blah blah, then you are a sophisticated investor. You do not need all the protections of the law. You're rich. You can take care of yourself. If you want to take a lot of risk and you want to lose a lot of money, fine. It's your money. You can lose a lot of it. You're rich. If a rich guy with 5 million loses 4, the government says, no big deal. We don't give a damn. Right? That's the government's attitude. The government's attitude is, we want to protect the little guy. Joe Blow, Joe Six-Pack, who comes back every day after, working on a construction project with a six-pack of beer, who lives from paycheck to paycheck, right?
Yeah.
Who usually has maybe $2,000, maybe $5,000 savings, and it's got a little bit of a pension fund, like $5,000, maybe $10,000. Maybe for 20 years working as a construction worker or a GM worker, he saved $50,000, maybe $70,000. The average worker today in the United States got a savings of $50,000, $70,000 in pension and other funds. So the idea is to protect those guys who have 20,000 or 50,000 people.
Make them to pay the tax.
Well, that's a different story. Who pays the tax? The idea, the law is attempting to provide the small, unsophisticated guy, all right? So these are saying, hey, gamble with your money the way you want to gamble. If you lose him, fine, no big deal. So, the sophisticated, blah, blah, blah. So, hedge funds were limited to people who can invest $1 million or more, $5 million or more, $500,000 or $100,000 or more. All right, so they were restricted to investors, all right? So, they invested in all sorts of things from emerging markets like Chinese stocks, like let's say Thailand or Malaysian, or all the rage was now Bulgaria, Ukrainian, Estonian, Irish, these were, Brazilian, Argentinian, Mexico, right? All of those. So they they could invest in very high-risk government bonds. Like Mexico has a tradition of blowing up on its creditors in order when they default.
Is Saudi Arabia an emerging country?
Yes, it is considered emerging as in developing country. Yes, it's a developing country.
No, I mean,
so all the
like,
GCC countries are developing.
Is it like China and India?
Kind of like, but not really. China and India
growing fast.
They are powerhouses. You get the camera produced in China and India. You get cars already produced there. You got laptops produced there. So they are already technological powerhouses. They are already very well developed. So anything you can think of, they already produce it. Saudi Arabia doesn't produce a lot of other things besides oil. I see these things, the clinics here, I see it says made in Saudi Arabia, I think somewhere over here, right? So I see these, I see some plastic bags made in Saudi. So some petrochemical derivatives will be made over here. But overall, there is not too much of a production. In Bulgaria, we're also in the same category. We produce maybe some shoes, maybe some shirts, maybe a tie, all right? We produce those little things. But China is a whole different story. Flash drive, it says
China.
made in China. That's what I think it says. Yes, yes, made in China. All right. You think you can zoom in on the China little thing there? Can it zoom in well or not? Does it say
Blurry,
China?
It's blurry.
Yeah,
Is it blurry?
blurry. Yeah.
Blurry. All right. Well, it is made in China. Oh, well, my mobile, I think somewhere it says made in China.
Blackberry.
All right. Your BlackBerry is made in China?
Everything is made in China.
All right. So,
Don't use everything.
all right. Let's get back to the
Maybe
hedge
they
fund
don't use
industry.
people.
All right. So, next thing. They invest.
Consume in China.
All right. Let me get a drink before we continue. Let's focus and finish on 5 minutes, all right? So, exotic. So, number one, they use a lot of derivatives. Derivatives, they love derivatives because derivatives are highly leveraged, highly risky, and they provide for huge profits. Also, hedge funds use 20% of gains incentive for management. So usually fees will be 1% of the managed funds and 20% of gains. So the Bulgarian fund, which I was telling you in the previous lecture, works in the same way. They get 1% of overall management fee for all assets under management, and whatever profits they make, 20%. Well, if they make losses, they don't pay out of their pocket, right? So there's an asymmetric incentive to gamble wildly, to make wild profits. And if you make a wild profit today, you get to keep 20% of the profit. If you make a wild loss and you bankrupt all of your investors, well, too bad for them. They didn't have luck. Hopefully they're going to get better luck with another fund manager. Derivatives. Another thing which is totally illegal in in mutual funds, but in hedge funds is okay, is shorting stocks and in general shorting assets, including short selling bonds, short selling stocks, even short selling commodities. Usually, the typical mutual fund is called long only. Now, hedge fund, the origin of hedge fund was that a hedge fund will exploit mispricing. Something which the hedge fund manager believed was undervalued, he'll go long. Something which the manager believed was overvalued, it will go short. And the idea was whether the market was going up or whether the market was going down. The fund was called market neutral. The market was not the fund was not sensitive on the market on the way up. It wasn't sensitive on the way down. The only thing it was sensitive was to mispricing. So many hedge funds attempted to exploit mispricing, where if something was underpriced or undervalued, they go long and they go short, and over time they would hope that the mispricing will get ironed out. All right. So that was the original idea when they were hedged, whether the market went up or the market went down. But then the original idea of hedging got perverted to doing all sorts of wild and crazy, highly leveraged, highly risky stuff. And the original idea was totally forgotten. During the last 2, 3, 4 years, hedge funds were all the rage, to the point where a few hundred hedge funds grew to be 3,000, almost 4,000 hedge funds. Well, the credit crunch came, the credit crisis came, they were highly leveraged, and 80% of them blew up. So, over 2,000 hedge funds have closed shops. Over 1,000 have stopped redemption because everyone rushed to redeem their money, so had a run on the hedge funds, and the hedge funds couldn't sell because they were holding illiquid assets. So at that point they say, well, the hedge fund is closed and liquidating. So investors will get their money maybe 3 months down the road, maybe 6 months down the road, maybe 3 years down the road, whenever. All right? And the hedge fund is not accepting anymore. All the hedge fund is doing is returning the money back on a prorated basis. All right, they use a lot of quantitative models, highly sophisticated computers. Some of them could do trading, thousands of trades per day and whatnot, but they use very highly sophisticated quantitative models, you know, in order to try to detect mispricing and attempt to arbitrage if available. All right, and this concludes hedge funds. I got 1 or 2 last sections, 5 more minutes. Let me delete this part over here, is REITs.
What do they mean, hedge funds of funds?
Oh, hedge fund of funds. So if some funds are bad, the hedge fund will short another fund. Or it will be just funding from the others, but if they're doing good, they may leverage up. So they may borrow money. Come on, girls. We're back. We've got 5 more minutes. You're going to survive without talking for 5 minutes. All right? Let's just finish with the last one, which is 10 REITs. So, let's zoom in. Real estate investment trust. All right. So, it is usually closed end. Closed end. It sells certain shares, it invests them in the property, and that's it. When it gets some rents, it may reinvest, it may pay back. That's a whole different story, what it does with its income. So that's the first characteristic. Second one, it is sold to small fish, to small investors. So they sell it only to small guys for 100,000, 500,000. So when there's a wild and crazy real estate boom, the small guy can profit from the boom. All right. The next characteristic is they provide for some, but not all, leverage. So they'll provide some leverage. There will be, most of the time, some minimum. Let's say 1,000 minimum. So you want to play 1,000, you can play. You know, for a small guy, that shouldn't be a big deal. The next one is that REITs are usually exchange traded. Well, this is part of the closed end. If it's closed end, this means that you can't buy back from your... Why REITs are closed end? Well, very good reason. It has lots of real estate. It owns 5 shopping malls, it owns a piece of Kingdom Tower and whatnot. It can't sell tomorrow morning if you want to redeem. There is no way it can sell, you know. Can't sell a garage, or can't sell 5% of a garage, all right? So its assets are not liquid. So if its assets are not liquid, it is perfect for a closed end. And if it's going to be a closed end, it's going to be exchange traded. It's going to be, of course, properly regulated by SEC and other authorities. So exchange traded is another key characteristic. All right. Now you have one group called equity REIT. Yeah?
Hedge fund is not regulated.
Hedge funds are what they call lightly regulated. In other words, there's a minimum of regulation on hedge funds. So hedge funds are investing like in the wild, wild wests. So equity REITs invest in the property. So they own the shopping mall, or they own 50% or whatever share of the shopping mall. And the other one is called mortgage REIT. mortgage rate.
Mortgages and construction loans.
Yes, they invest in the mortgage. So in here, they invest in the real estate as an asset class. Over here, they invest in the mortgage, which is a financial asset. So in the first case, the investment is in the real asset. In the second case, in the financial asset. Here, the financial asset is relatively well protected because it's a debt instrument. Here, it's more of an equity instrument, all right? So here, your mortgage is protected by the equity of the actual owner, whoever gave it a mortgage, all right? And here, you're exposed both to the gains and to the losses. In a sense, this could be somewhat higher risk, higher return. And this is relatively safer itself. And finally, there will be, so this is the property, this is the
Loan.
mortgage or the loan. And finally, some will be providing a hybrid of the two. Where they're going to say, we're 50% in equity and we're 50% in mortgages. All right? Let's see what else. Usually they are sold or not necessarily true, but they are sold as inflation hedges. Of course, now we see that they're not really an inflation hedge. In other words, after a big real estate bubble, real estate might be deflating while the overall economy is inflating, where all prices are going up and real estate could be going down. So, after asset bubbles, meaning real estate bubbles, usually it is not an inflation hedge. But otherwise, especially the equity REITs provide a very good inflation hedge if you purchased when the real estate was not overvalued, all right? So again, this is like any other investment. It depends. Did you buy when it was overvalued and then things are going to go wrong anyway, or did you buy when it's undervalued at a good time? All right, that is done. Interaction with real estate, finance, globalization. So the last section, which is, I'm going to skip 11, 12, which is 13, is the globalization of the mutual fund industry, which has been a basic trend throughout the investment world, is that mutual funds have steadily globalized. All right? Is this good enough for tonight?
Good enough.
All right. You're not going to say hello to the camera?
Today,
Highly leveraged